Welcome to Verified Expansion. I'm Scott Letourneau. For 30 years, I've helped brands across the globe expand their business into the United States and avoid different landmines when it comes to U.S. taxation issues, KYC issues, verification, suspensions, and appeals, things of that nature to make sure they can be up and running, selling, and ultimately be profitable with their overall structure. Now, the reality is if you are outside the United States selling into the U.S. and you're in a situation that requires forming a U.S. company, today very common is Amazon brands we work with that are selling in Amazon from a foreign country, and they want to expand to TikTok Shop. And currently TikTok, to set up an account with TikTok Shop, requires a U.S. company. And then we get into today's particular subject where when you're doing transactions between your foreign company and a U.S. company, there is a very important subject you want to keep in mind, and that's something called transfer pricing. And if you don't have the right documents in place, this is something that could go badly for you upon a audit in the United States, which could happen for several reasons, depending upon how the structure and how it's taxed. And were you subject to U.S. tax? Were you not? All those factors come into play. But if you're doing transactions, there's this extra layer in this category called transfer pricing. And we found that a lot of brands might skip over this very important step. And our goal with this bonus for you as a client of ours is to avoid these pitfalls and landmines. So what I've done is bring in an expert on this subject, and we're going to walk through the big picture, what transfer pricing means, when does it come into play, what are some of the documents you need in place, is this something you do up front one time, annually? We're going to cover the big picture. So I want to bring on and invite my special guest. He's one of the best in the game. His name is Eran Shif. He's worked inside the tax authority arena for many years. He's advised at Ernst & Young in Tel Aviv and in New York. He built and sold a transfer pricing documentation startup to Avalara, the big global sales tax firm that you think of. He ran Avalara's transfer pricing business when he worked there. He now leads IncoDocs to automate intercompany strategy and compliance. Welcome, Eran. How are you doing today?
All good. Thank you. Thank you for having me, Scott.
Yeah, it's awesome to have you here. Now, before we get into the tactical part of this, can you give our listeners a 60-second, maybe credibility snapshot, when you started, the type of companies that you worked with maybe back then, and who are you working with today as far as maybe in the e-commerce industry? What type of clients come to you now?
Sure. So I think, worked for, like you said, like in EY, also in Tel Aviv and New York, and really had a chance to work with smaller startups to Fortune 500 companies. And I think that macroeconomically, what we saw in the last few years, that we see that it's many companies where even there are SMBs are becoming multinationals, right? Very, very early stage in their life. Yet you have the same issues as any other big company, but you're an SMB. And this is kind of like one of the things that I'm really proud of, that to find like a package that can provide a clear way to those SMB multinationals, how to do the business, how to sell the things, and one end to stay in compliance, but also in the other end, also to make it reasonably make sense also with tax planning, etc., not to pay too much taxes, and wrap everything in a very affordable package that can fit those multinationals.
And that makes a lot of sense, because I know clients and brands that we've worked with, they might be at 1 million, 5 million, 10, 15 million in annual sales. And when you think of multinational companies, you think of hundreds of millions, you think of Ernst & Young where you worked, Deloitte, and big fees for this. And you were able to come in and simplify the process and provide an affordable, I would say, service for sellers in the range I just described, that they can be in compliance and they can be protected in case worst case scenario if they have some type of audit. Is that
I will just add, I'm 100%. I will just add on that. So I think there are two industries which kind of like really become multinationals earlier in their life. One is tech startups, and the other one are e-commerce. You need to be, in those two scenarios, you need to be multinational. You go to a global market, and This is one thing, and the other end, from the other end, you need to find. It's not only to check the box, meet the compliance 100%, but what if we can do it in a smart way that can literally save money, save taxes, tariffs, income tax for those companies, and wrap it everything not only in a budget way, but also in a simple way. That in the end of the day, SMB, unlike big company, they don't have 20, 50 people in their finance team. It's one person at the best. And so also to come up with a method that it's easy to monitor and simple to execute.
That makes a lot of sense. So as you're saying, there's two prongs here. One is compliance, so things don't go awry upon an audit or doing it after the fact, and we'll dive into that. But two is strategically, what if you could save taxes when you're doing multinational business, which with e-commerce these days, with Amazon in multiple countries around the world, a lot of sellers want to sell on TikTok, Walmart. Ulta Beauty is the latest, newest U.S. marketplace. I had a client a couple of weeks ago. That marketplace just opened up. So there's lots of opportunities. So we're talking about compliance and tax savings. That's why this is important. Does that sound about right?
So, and I would add maybe tax savings, but also reducing the tax exposure. So we want to do something that would not be too high risk. We want to lower the risk, but on the other end, also to lower our taxable whatever.
And thanks, Eran. I think that's a really good point about lowering your risk, because I think there's a lot of global sellers. Let's maybe start with a big picture example. If somebody's in the EU, let's say they're in Germany, and they're selling on Amazon, the United States, I think some may be doing some things incorrectly. But before we get to what they're doing incorrectly, let's start with an example of maybe who doesn't need transfer pricing, and then let's transition to a situation that they would need to look at transfer pricing. So who's in the first group of somebody that might be in Europe, for example? They could be Australia. We'll start with Europe, and they're selling in the US. Who's somebody that if they're only doing this, they don't need to worry about transfer pricing?
Right. So if I'm in Germany and I'm selling directly to customers in the US, you don't need that transfer pricing. What we're looking for, where it becomes kind of like more of an issue, it's when the business, let's say in Germany, also has another entity in another country or in other tax jurisdictions, if we were more precise. And it does in those cases, there are like certain rules that apply on any multinationals. Once you are considered a multinational, meaning I own some or the same shareholder own one company in Germany and another company in the US, for example, it's what we call related parties, then there is an issue. And why there is an issue? Very simple. Each tax authority want to make sure that they get their fair share in the pie. I don't want the IRS or the German or the HMRC, for example. Everybody want to make sure that they get their own fair share of the pie, share of the profit. And basically, from here it begins. We want to demonstrate for both tax authorities, hey, that the profits that we have in the end of the year here in the US and also in Germany are at arm's length, are correct and are right and aligned with the facts and the business.
So that makes sense. So if we have someone in Europe and they're selling on Amazon.com, they might be selling in Amazon in Europe, and they have one structure, could be a UK limited company, a German company. This doesn't come into play for them. It's when they get to step 2 that they might have another company in another jurisdiction. In this case, again, what's most common for us, we think a TikTok shop, potentially Walmart, that might require a U.S. company to meet a W-9 requirement. We know, stepping back to Amazon, somebody in Europe can sell on Amazon and fill out a W-8BNE. So they, in most cases, might just stick with their EU company. Some situations, there's a big brand in the EU and they want to sell in the US and they're in a high risk category for liability and they want to separate the US sales from the EU sales. So they form a separate company for Amazon for that. That could be a possibility. But at the end of the day, we're really talking about two companies that are related. Is that correct?
Yeah. 100%. And I think it's not even like big brands. And I'm just like sharing things that I see from the industry. And so it's like, I think it's around 500,000 even or million or more. The idea is already to have this US company, and it has some other things that are not related to tax at all. I mean, I think that this is something that also more and more brands, non-US brands, get it when they sell into the US. First of all, from business-wise, I mean, again, nothing to do with tax, higher credibility, higher loyalty from U.S. customers. When you have a U.S. entity, you have an address, you have, I know, I get an invoice from a U.S. entity, not from a foreign entity. So business-wise, it's already a positive thing. Another thing that I like to just tell to my European clients that I ask them, what's the national sport in the US? And it's not baseball or football, but it's taking each other one to court. And having a US entity, and again, it doesn't matter if you sell only in Amazon, I think that it's any sales in the US. Once you have a US entity, it's like a legal buffer because the contract, the transaction is between the US customer and the US entity, not a foreign entity. All the assets, all the money, most of the things are in this, whatever, HQ in the UK or Germany. The US entity is almost an empty company. That alone already reduce the exposure. Again, it's not a tax exposure, it's a business liability exposure that you can use. So these two things, again, regardless to tax, are already, I think, a huge advantage. Add on that also the tariff issues, and we'll discuss it soon, how we can utilize having a US entity also kind of like to manage the tariffs impact.
I agree with that 100%. Just to, add to what Eran's saying about liability in any business situation, if you have all your eggs in one basket, you have, let's say, a UK limited company that runs your EU business on Amazon, for example, you're doing millions in sales, any legal issues to that will expose that one company, all your assets. Now, if that company then starts selling in the United States, as you say, lawsuits are our biggest sport in the United States. It's kind of like once you build wealth in the United States, you got to figure out how to prevent freeloaders from taking it from you. I live in Las Vegas, and there's a reason there's dozens and dozens of signs by attorneys that say, a wreck, need a check. It's almost comical to the point, not if you're on the wrong end of this, that, hey, if you get an offender bender and you figure out how it's not your fault, we can get you money very quickly. And that's why automobile insurance rates are extremely high in Las Vegas. So that's just the mentality in the US. It's one of the biggest markets in the world, but there's also this other side to it. And having, especially if you have a high risk product in a category such as baby exercise supplements, it's probably hard to get product liability insurance, perhaps in your country, whether it's Australia, some other country around the world. So we get a lot of clients, they want to set up U.S. companies for product liability insurance to, as you say, reduce your exposure or risk. So those are some of the options. If you're going to work with U.S. retailers, you want to get in different stores, they're going to require a U.S. presence with an operating presence, and we help you do all that. So that is the advantage of that, which gets, again, lowering your risk. Then we get into taxation and this particular subject, which comes into play. It's very important. Before we talk more about the U.S., one big picture question is, you mentioned earlier, if somebody's multinational, do you work for clients that, let's say they have an Australian company and a Hong Kong company, or a Chinese company and a Hong Kong company, or a European company and something in another country, or just U.S. in another country, just so I understand that?
One of the unique features of transfer pricing, international tax, it's one of the most globally unified rules. The same, basically the OECD, it's an organization that many of the developed countries are a member of. And all the tax authorities in the world basically adopted the same principle. So it's almost the same. I can read a transfer pricing report between Canada and Ireland. It's the same as US, Canada, or any other thing. So it's one of the most globally unified rules. I mean, maybe some countries have some small features add on, or or it needs to be in a certain language, but 100% it's the same methodology, same idea all around.
Wonderful. So that makes sense. So you could provide support for people. It's not just people that have a U.S. company, it could be two companies in different jurisdictions. Correct.
Yeah, exactly. De facto, I mean, most of my business, it's related to US because, again, maybe it's because it's the biggest consumer market in the world, and all the multinationals somehow wants to be here also.
That makes total sense. And with that, let's start with the misconception, maybe a big picture one that I've seen talking to other tax professionals on this subject. There seems to be maybe a misconception that what we're talking about today is, does it apply to me? Meaning, am I big enough? We hear this term multinational. I know what comes in people's minds is that, $1 billion company, 500 million. And, I've heard a term before, 50 million, then you don't maybe have to worry about it. Tell me a little bit about if that's just totally a misconception, or are there different rules at a different size and revenue when it
Yeah.
comes to transfer pricing?
Yeah, there is some linkage between volume and level of compliance that you need to prepare. So yeah, there are a few buckets in this thing. I think the biggest bucket, it's like, I would say $750 billion and more. So really big, 750 million, sorry, $750 million companies sales. And above. Many, I would say that there are certain documentation requirements. It may change from country to a country. There are countries that say, hey, there's no threshold. Once you're multinational, you need to prepare ad documentation. There are countries that have, hey, you don't need to prepare certain types of documentation only if you meet a threshold, and not necessarily the 750 million euros threshold, but some countries can be 50 million, some countries 10 million. However, in all those countries, the tax authorities expect that the transaction will still be with at arm's length. So you need to provide something. And there are solutions for those SMBs. Yeah, you may not need the full big shebang, 50 pages of transfer pricing, maybe not, but you need something. And you need to show some kind of document. It can be intercompany agreement, some kind of a memo. In taxes in general, I mean, the difference between a taxpayer or a client that has no documentation at all versus someone that have something that makes, even it's not the full big shebang, but it's reasonable. It's based on the same principles like the OECD and the IRS, etc. You will be in a much stronger, better position rather than a client that doesn't have nothing. So only by that, already you're kind of like in the line. Add on that, on the top of it, also the tax planning feature that we want to add into those those two documents. So it's not only check the box with compliance, but there's some smart way behind it, kind of like to optimize the tax and reduce other exposures.
And that makes sense, because what I hear and what I think some people are missing is what's changed in the last 24 months, especially the last 12 months in regard to organizations such as FinCEN, the Financial Crimes Division. And it may not be directly related, but I believe it's indirectly related, even though some people say, oh, the BOI report a year ago dropped off, so don't worry about the financial crimes. But they're fining. A year ago, they fined a U.S. bank $30-some billion. They're finding other banks that don't follow KYC rules and this. Then it was designed to report banking to the IRS and the flow of money. And then you mentioned the OECD rules in different countries. I know the UK's made some changes this year. And it seems just globally, these countries are tightening up because they don't like the story of, one hand, I have a single member LLC disregard in the United States, and I don't think I'm engaged in U.S. trade or business. I don't be effectively connected to income, so I won't pay any tax there. And there's a tax treaty. But on the other hand, I'm not really doing business in my country either. So maybe it's just a, foreign dividend and see how that's taxed. And it's kind of like you're in no man's land. It kind of falls into a hybrid situation. I know that's a little bit beyond the scope, but I think these other countries are like, hey, are you doing business there? Or are you doing business here? And if you're doing business from this company to this company, which is more what we're really talking about, we want to know you're just not moving money around like at the last month of the fiscal year because you figured out, crap, I actually have several $100,000 in profits in this U.S. company. I need more in my German company because I got to do payroll over here to myself. I have some other personal expenses. Do you see things from your viewpoint that have changed over the last 12 months? Am I on the right track with this?
Yeah, 100%. 100%. So two things to consider. First of all, the ones that maybe no man land, etc. One of the things that tax authorities also in the tax treaty is that they take care of it. It's like to make sure that there's no, they want to avoid a no tax situation, that you're not taxing it. That's like a big red thing, and they will set rules basically to avoid to find the things and to avoid it. On the other end, you also, and we spoke about kind of like threshold and men's documentations, kind of like, and if you use the UK, I think also in the last 12 months, you can see all the publication that they make. And basically, it's like emphasizing again and again. Yeah, we have some, for example, you have some kind of a threshold that only from then you need to provide every year transfer pricing report. But on the other end, we want to see something. It doesn't say that those transactions cannot be at arm's length. They need to be in arm's length, and you need to show how it's in arm's length. The kind of like it's shifting towards kind of like those, and I think it's like a trend that you will see that the threshold are going down and down and down, because tax authorities get it that they're losing a lot of taxes if they're like, hey, we're gonna charge look at only X amount of money. The other way around, also look at the US, which is a bit different, but it's kind of like important to notice. Kind of like the IRS strategy is kind of like the stick and the carrot, meaning I'm the IRS, I'm saying, hey, Scott, you don't have to prepare transfer pricing report. You don't have to. However, I can apply some penalties if I don't agree with your price. I think it should have been 10%, not 3%. And in addition to that, there are penalties which can be 20 to 40% of the additional tax. That's kind of like the stick. However, the carrot will say you can get a penalty protection if you will prepare this document in advance before you file your tax return. So this is another strategy how tax authorities kind of like trying to incentivize taxpayers to, hey, we just want you to work at arm's length. Show me that you work in a right arm's length. That will be already 80% of the thing you're off.
Very good. So let's go to a practical example. Again, back to Europe. No offense to all the other countries. Maybe we'll use Australia as an example, or other countries around the world, Asia, things of that nature, countries over there. We have let's say a German company, they set up a U.S. company, U.S. companies on TikTok, selling, German companies on Amazon. And in a lot of cases, what we see, or what I see, is the German company that has experience on Amazon's built a brand, they have their team. They might work with an agency that does the ads and all that for the Amazon, helps look at their listings and maximize their closing percentage on the different images and things of that nature, using AI to improve things, all of that. And they say, well, I'm going to provide those same services. If they do it in-house, I'm going to provide those same services for my U.S. company. And I'm just going to invoice my U.S. company that's doing TikTok Shop $10,000 a month, and it's going to wire $10,000 a month. I have an invoice, services, wire. Is that good enough, or why is it not? If it's not, and what then will kind of lead into the different categories of transfer pricing. But a lot of people are in that situation might just say, that's good enough. That's what my accountant told me. That's all I need. And technically, obviously, nothing matters if you don't get audited. So who cares? But we're talking worst case scenario, you get audited, and maybe they question that's not enough documentation. What are your thoughts on that?
You manage a risk, right? So of course you want to prepare. We just want to make it to manage this thing and manage this risk together with a strategy, right? So why $10,000? Is it good? Is it more? Maybe less? And again, once you have a very clear strategy, what should be the end game, and then basically easy you reverse engineer. Again, so you're like it will be like the right amount. Meeting the compliance, and also taking into account kind of like also the planning that what we want to do. Is it too much? Is it less? I don't know. But again, so this is why I kind of like a reverse engineer and come up with the not just like 10,000 because I thought it sounds okay. No, there is some documents or some thought behind that we can easily and clearly explain to anyone that asks. So this is like, so that's that kind of just like, instead of like a bulk of charges that have, where do they come from?
Very good. That makes sense, because I agree at the end of the day, it's about compliance and managing risk. And when we're talking not a big amount of service fees that Eran has developed to get an extra level set of documents in place, that if your company's looked at, and even one day, 2 years ago, something made sense and you did some work to kind of reverse engineer what other company, but now you're just kind of picking a number out of the sky. Why not protect yourself in case when scrutiny is getting tighter and tighter globally on this particular subject? So let's transition into, I guess it would be the three buckets of transfer pricing that may come into play. Maybe we start with the one I just described. What category or bucket would that fall into?
Right. So basically, transfer pricing apply to all types of intercompany transactions, right? It can be purchase of products, goods. It can be services. It can be a license, like use of intellectual property, and it can be loans. Company A provided a loan to company, so then you have like interest rates. So basically, that's kind of like typically the word of transfer pricing. It doesn't include, for example, payroll between an employee and a company. That's not part of transfer pricing, as well as dividends. Dividends, it's when I have a company with profits and I want to distribute the profits after they were taxed. For example, in the US, and I want to distribute them back to the parent, to the shareholders. So again, that doesn't fall under transfer pricing. What we're talking about is like the ongoing business, the ongoing activity, which falls under one of those, typically those four buckets. Just like to add some interesting data about kind of like all those buckets. There is in macroeconomics a term which is called global international trade, which basically aggregates all the exports in the world, exactly what we said, like services, products, licenses, etc. That amount, it's about $30 trillion a year. That's kind of the global export, And what's an interesting third of those export transactions are transactions between related parties. It's exactly when a subsidiary in the US, for example, purchases a product from the German manufacturer and resells it back in the US. Or it's, for example, a startup that have an R&D center, or a call center in a different country. So the magnitude of those intercompany transactions are quite significant in the global economy.
So thank you for that. So one category, we'll call it services, which is probably fairly common, where company in one country, company in another country, and there obviously it could change which country. U.S. corporations, 21% corporate tax. Maybe in another country, the tax is about the same. Maybe it's lower. Generally, the theme probably is they'd like to see more profits come back to the home country. Probably the exception to that is talking to agencies that support Chinese clients. They want to get money from China to stay in the U.S. to buy U.S. real estate. Whole different strategy, right? But let's go back to the basic one. If you're trying to get, profits from the U.S. back to your home country, maybe that's where you have an office, maybe some payroll, some workers for you. Maybe you have, it's based upon some kind of retirement plan. Then we're in the services category, right? And so again, we talked about just having an invoice going back and forth is probably not enough. When we talk about these 3 or 4 categories, are the documents the same or different depending upon what category we're in?
I would say they're the same. I mean, in the end of the day, it's the same. It's the same category, the same documentation, the documentation types. The analysis may be different, the wording may be different, but these are the same principles in the end of the day. The only exception I would say that in transfer pricing, and maybe it's a good kind of like also to pivot about it. But before that, something that I had in mind and I don't want to forget. It's not only that the tax planning, etc., transfer pricing services and the thing. There's another issue which is super important, and it's the protection of the intellectual property. So that also relates to all kind of tax event. Who owns the intellectual property? And intellectual property, basically, it can be the brand name. It can be a know-how. It can be a manufacturing know, a patent, something intangible. And the intangible products are the main driver where the profit should be. So if I own in Germany, we invested in the brand and in the design and product. We own the IP. It would be very super important to protect, to make sure that the IP is continuing owned by the German entity, and we don't want to provide any type of arguments or leads, for example, to the other tax authority to say, hey, we also own part of it. Even legally, it's there. Economically, we have also participated in the risk, and we also want to be part of it also. And that can be very severe tax consequences, not maybe right now, day one. But Scott, imagine that you have a business and you want to do an exit, sales. You want to add a partner. What's the value of your business? And the things that having does like concentrating all the IP in one place, basically kind of like also help in the end of the day to make the value of your whole business even higher. Again, we're reducing all those tax exposures that are going to be there. So whether it's a service or whether it's a distribution, one of the key things that also we want to take into account is also to securing the IP. So going back to what I said before, it's not only tax compliance, tax planning, but again, the tax planning really in the wider view of it, also like I said, like future exit strategy or other parts to take into account. So that's like one that kind of something with the IP, which is a crucial thing that I wanted to.
That is critical because when you form a second company, right? You let's say it's in the US as we've been talking about, the goal is what's the end in mind. And some people do have a new product, say it could be in supplements and they want to launch it in the US and the plan for that product and brand is to do an exit, just as you're saying. Maybe the EU company is not going to exit, but the new product is going to be part of a new brand. And like you say, who owns the IP? Is that going to be part of the valuation? Is it not going to be part of the valuation? And there's different ways to take a look at that. So that's a really important consideration. So if we take a step back in the big picture again, then we'll drill down. We have these different buckets of services. We talked about IP. Then we're going to talk about inventory in a moment. So we have at least those three buckets. And I suppose there's a situation where two companies could be implementing all three of those. Am I saying that correctly?
Yeah, I mean, there's no limit. I mean, I can have I took a loan. We're providing some R&D services to our foreign company, and also we're selling our legacy product that also was developed like a few years ago from the same company. So 100%, those all those things exist. I'm just like rooting it back to those SMBs, and we talked about simplicity. Let's make things simple, not overcomplicated, because we are SMBs. We don't have 20 people in our finance team. And again, one of the key things that also let's keep it simple. So if we can kind of like unify it and basically kind of like make it like a single type of transaction that will already kind of like take into account all those other features, that's great. I mean, we just made the life of the SMB easier, less documentation, less expensive, easier to monitor, etc. So I think that's again another kind of like value and principle that I like to highlight with my clients.
And that makes sense. And before we go into the model example of inventory and what can be used there and what are some logistics companies doing in that area, to go back to the big picture concept, you might be doing transfer pricing in a couple different areas. Does each area need its own documentation or can it be all in one? What's best when it comes to being, if you were worst case scenario audited, what would you like to have in place?
I don't think it's like the number of documents matter. It's like what's in the document. So it's really like a technical issue. But the important thing is that you want to cover those types of transaction. Yeah, we have a loan, we have a license, and we also buy and sell products. It doesn't matter if it's in three different documents or like in one big pile, at least, but we address them. We kind of like we touch base on them. We know the pricing for each one of them. We have an agreement that basically can be like one big agreement, that's a service and distribution agreement, or two different agreements, one for service and one for distribution. So the bottom line is just like to identify and nail those intercompany transactions.
And that makes total sense. And let's transition to the big subject this year, tariffs, import costs, overall situations. I know there's some logistic companies. We worked with a client together from Australia on this, where they were using a particular model that they could, if they had a U.S. company and they had inventory, I believe it might have been in Australia, importing into the U.S., that there were some things that could be done on this logistics and this platform. They do actually, in this case, the sales and the refunds and some of the customer support. It wasn't a marketplace like Amazon, but it was a logistics company. And they were asking for a couple simple things, which is, hey, just set up a U.S. company, which we'll talk about in a minute about does it make a difference what type of company? Obviously, it doesn't overall about taxes, but in reference to transfer pricing. Then they kind of ask for a particular percentage. And it's not like they say, give us your documentation. It's like, you pick a number and put it in here and we'll run with that. Can you explain, because this is one that's, I think, generated great interest. And first of all, who does this apply to? In other words, if you're an Australian company buying a product from China, shipping it in the U.S. versus two companies, walk us through that example and how does your services come into play and how do you help somebody in that type of situation?
Right. So let's kind of like reverse engineer and what's like the worst case that we want to avoid in terms of tariffs. It's that the tariffs will be applied on the retail price. If you're a seller, that's your biggest concern, your biggest risk, right? Tariff will apply. The agents, the CBP will decide, hey, the value should be $100. We're going to apply the tariffs on the $100. Whether the cost was $10, doesn't matter. That's kind of like your biggest risk. So kind of like the idea is what can we do in order to kind of like to reduce this exposure? And on the other end, like if you remember, so we have the compliance, etc., but also we want to reduce existing exposure. So if you look at the spectrum, so on one end we select the retail price, tariff applied on the retail price. The other side of the spectrum will be cost. Whatever, manufacturing cost, and I'm using cost as is, whatever it cost me from the Chinese manufacturer, I'm Australia, I'm using the same price and import it to my own company, right? So let's say that we after we decided to open a US company and we have a US entity, and it's important to understand that again that the US entity is kind of like the importer of record. They are the one that, at least on the books and all the papers, they are the ones that purchasing the products. They are the ones that selling or reselling the products to the US customers. So when establishing this company, there's, let's say, the US subsidiary, the US company, although it's in the same group, you need to look at it as if it's a separate entity and what it really means. From the Australian perspective, the US entity, their US subsidiary, is their biggest client, or one of their biggest clients. Why? Because this client, this US entity, basically purchase all the products and then resell to the whole US. The idea is, in the end of the day, not only the TikTok thing, but kind of like you think like broadly, you have a US entity and they are responsible for the whole territory, which is the United States or whatever, North America. So the first thing that comes in your mind, if you are the Australian manufacturer, seller, would you provide a significant discount to a wholesaler that purchase maybe like the biggest amounts, right? The answer, of course, yes. It makes sense to provide a certain percentage of discount for such a big client. So having that, put that in hand, put in spot, basically that already can help us to reduce kind of like the exposure, what we said, of the tariffs that will be applied on a resale price. They should be applied on a wholesale price. It's a question we'll discuss it later. What should be the price or how to come to this price? But this is like a very important stuff. We have a wholesaler in the US. It happens to be our own company that we own, but it's a wholesaler. It's a separate entity. And what's important for customer perspective, again, we're trying to diffuse this big exposure of tariff on resale price. The US entity should have the feel and look as a wholesaler. What does it mean? It means that imagine that we are now an audit. We want to see that the US entity is the entity which issues the invoices to the US customers. We want to see that the US entity has purchase orders from the Australian manufacturers. We want to see that they are taking title of the products before they enter the US. So for example, it can be CIF or FOB, all those trade when the inventory changes titles. We want to see, for example, that the internal local logistic expenses are borne by the US entity, not by the Australian company. And again, the look and feel of a completely independent wholesaler. Again, we own it, but it should act like that.
And that's a really good point. So, for example, if you're a wholesaler, meaning the U.S. company, correct me if I'm not saying this correctly, would be technically the retailer selling to the U.S. customers. It purchased the product from the Australian company that is wholesaling. So probably the U.S. company would need the Australian company would not be charging sales tax to the U.S. company. They would get an exemption certificate from sales tax. So that's why I would not charge my Australian company sales tax. Now, again, when I'm selling, if it's on a marketplace, Amazon's collecting sales tax. A couple of states that may want you to file 0 returns. That's a different subject. If I'm selling on my own website, Shopify, then we get into a bunch of nexus rules about sales tax and all of that. So that could be a component of that. So that's a situation where, does that not apply if let's say the Australian company is selling on Amazon and they set up a U.S. company to sell on TikTok Shop, and the Australian company only buys inventory from China to import into the U.S., goes to the importer record, goes through a 3PL and goes to Amazon warehouses on FBA and they sell it. In other words, the Australian company doesn't have any inventory in Australia. They're not manufacturing a product in Australia and selling it to the United States. So if they're just importing from China and the same thing, now we have a US company that is selling a TikTok shop and it's now going to also import from China. When it comes to these 3 or 4 different levels of transfer pricing, does that remove the first category of inventory between, because that's not really happening? I'm not sure if I'm saying that right. Feel free to correct me.
You're right, but there is something else. So if I'm the US entity and I'm purchasing the products directly from the Chinese manufacturer, but I'm purchasing a product that the Australian company owns, their design, their brand, whatever, their packaging, whatever they do. So there is something. I'm buying a product that it's owned by someone else. We're now in a different category here that maybe it's royalties, right? I'm buying from someone else a product that you designed with your brand. You should earn some kind of royalties. Now, royalties, there can be one way to do it. From tax perspective, it's not always the most effective way. There is some kind of I'm just using the term which called withholding tax. We're going a little bit more technical on the income tax and tax treaties, but there are some tax treaties between the US, and if there's no tax treaties, it's also apply that the IRS can say, hey, every payment that now you pay back for those royalties, you have to take whatever, 15%, 10%, 5%, 25%, 30%, depends on the tax treaties. This is another way to look at it. Typically, what we see in order to apply kind of like this model that the US entity purchase products from the brand owner, let's call it the brand owner, non-US brand, to the US wholesaler that sells it afterwards to retailers and direct to consumers. So we want to see kind of like the intercompany invoice of inventory between the US entity and the Australia and the non-US brand. By the way, the goods can be shipped directly to whatever you want. I'm the Chinese manufacturer. Tell me where to ship it, I will ship it. But the invoice, the Chinese manufacturer will invoice the brand, the non-US brand, not the US wholesaler.
Is it possible in that scenario, and would it make any sense, maybe not, that the Australian company that is the brand has the money, the cash flow? Is there any advantage for it to lend money to the US company, and the US company just buys the product directly from China into the US company? You lose the advantage of the transfer pricing situation there, but there is a loan.
There is a
Am
loan.
I making things more complicated, or?
I think in the end of the day, it's more complicated because it's like really more unique transactions. Let's go forward. Let's say that the US business is very profitable. Now you have a lot of profit in the US. You have most of the expenses in Australia because you need to pay like payroll, you need to pay for the design. Again, to move the money back to Australia, it will be after you taxed it in the US, and then a dividend, again, depends on the treaty, another layer of tax. Again, you can do that, but it's not the most effective way. There is another issue of the IP. So, hey, who owns the IP? Maybe now the US entity owns the US IP, the brand in the US, and they are the rest of the world. So, and again, that goes if tomorrow there will be an exit or you sell the business or maybe you even bring a partner, hey, should we have to pay also something to the IRS? Again, so really taking kind of the best practices, we want to kind of align the facts. There's nothing in the US. All the people, the employees, the entrepreneurs are typically where the brand is, not in the US. US probably has no employees. So again, we also want to align kind of like the facts with the tax model with the facts.
So this is where the planning and transfer pricing comes into play. Even likely could be before you form a U.S. company. Overall, in the big picture, could be maybe you have a U.S. company in place, but you haven't started the transactions because, again, you're at this point where we need to buy more inventory. We want to sell in the U.S. We need to get it to TikTok Shop. We're going to use Amazon's fulfillment services to ship even for TikTok Shop, which you can do. And you're like, well, wait a minute, which should I just have my Australian company buy it? Should I have the US company buy it? How does that look? What's better? That's where this would come into a discussion with you, leading to what are the transfer pricing options now that we have two companies. Does that sound close?
Yeah, 100%, exactly like that. Set up a company. Again, we know why we want to set up a company, what we discussed before, all the pros, all the benefits of having US entity, just like kind of like close the knots between in what price we're going to sell, what will be the impact of the tariffs. And I will even like take it maybe the next step. And like I said, so let's say we need to set up kind of like the wholesale price. We have a US entity, they are our wholesaler. They have the feel and look of a wholesaler, everything that we discussed before, right? All the invoices, purchase orders. We have a contract between the US entity and the non-US brand. Basically, I think that if you think about a timeline, and we have the holidays coming soon, right? And I just like spoke with a couple of e-commerce. That's like season. That's like in certain cases, that's like the busiest business that they incur. Most of their income comes from this period, and their impact of those tariffs will be the highest right now. So if we can do something now, and we can, it's like, I mean, today to open a US company, it doesn't take so much time. It's not like it can be done relatively fast. And having this US entity, we'll discuss which type of company, but once you have this company, we can already imply that and set up a price. What will be the invoice price when we are importing, when the US entity as an importer of record will import the goods. So this will be kind of like the first stage. What should be the price? And there are many ways there are few ways typically how to evaluate that. Some companies using kind of a cost plus. Manufacturing cost was 100. We'll use 20% plus 10, 30, whatever. This is one way from bottom up. Another way to look at it, it's from top to bottom, which more relates to the discount, right? So we will meet the non-US brand. I will provide my wholesaler, my biggest client, X% of discount because they are buying in a value of $1 million a year. What should be the discounts that I should provide to such client? And it's a question in how to come up with this pricing.
That makes sense. Let's talk a little bit about entities, then time frame, then we'll get into a little bit of an overview what services might look like. So in general, we get a lot of people that reach out to us who maybe haven't started selling, which is not what we're talking about. And commonly, you might hear a U.S. single member LLC disregarded. And the hopes is that maybe they're not subject to U.S. tax, and that gets into our U.S. trader business and effectively connected income. And it gets a little complicated because it's not black or white. And depending upon if you're a treaty or non-treaty country, all those factors come into play. So that could be somebody that's doing drop shipping or something like that, and they're a foreign individual. And that's not what we're talking about. If they're trying to get on Amazon, we get into KYC, geographic location mismatches, getting verified. That's a whole different subject. We're talking, again, somebody has a company in their country, could even be in China. They want to set up a U.S. company. And so when we set up a U.S. company, does the single member LLC disregarded make any sense for this, or are we really talking a corporation or partnership? Give us a little bit of a quick overview on those three choices.
So I think it's kind of like a one rope with two ends, and it's hard to kind of like hold the two ends of the rope because it's a very long rope, right? Kind of like I'm trying to metaphorically try to capture it. And the two sides of the rope, it's the tariff CBP, and the other part is the income tax. So let's kind of like zoom out for a second. In the world of tax, we have two segments of tax. We have indirect tax, which is typically a transactional tax, tariffs, VAT, sales tax, which applied on the transaction, on the invoice. One thing, we have another tax segment, which is income tax. What we call it's an annual perspective. It's the annual tax returns that companies need to issue. And basically, we are taxed over there on the profit. Revenues minus cost, profit, and income taxes divided on the profit. Right, so these are kind of like the two segments of or buckets of taxes that we need to consider. And this regarded entity, on one hand, kind of like, let's put it this way. So we explained before that in order to kind of like substantiate a wholesale price. We don't want to be tariffs to be applied on the resale price. It needs to have the look and feel of a complete company with a complete business. Invoices, purchase orders, paying to suppliers in the US, managing inventory, that's a business. And I think that having a disregarded entity with something that looks like, smells like, and feels like a business, that's maybe that can create a tax exposure in the US. So from that end, that's something that kind of like, you know what, it doesn't, that's like my biggest concern, that it's entity, we don't have to pay taxes, but in order to do so, basically you need to have like almost no activity or minimum activity, and that contradict the principles that we said before with the tariffs. And I think that from in the e-commerce world today, the tariffs are the biggest issue. So what I would think is, first of all, let's whatever we can to reduce the tariffs impact, and then basically also to goes around it and kind of complete the picture also with income tax, transfer pricing, etc. So my bottom line is that in those cases, I don't think that this disregarded entity works. It literally can provide more problems, bigger issues later, and the alternatives are much better.
And I agree with it. It's a popular entity in its place, and a lot of people, even on TikTok Shop, who new to selling, try to do that. Then the reality is TikTok Shop requires a W-9. And if you're a non-resident, that doesn't work. We got to be a partnership or a corporation. But if we zoom out, we're probably thinking about, when we think of multinationals, we think of corporation here. And besides a lot of people just think, oh, a company. I formed an LLC with the state. That's not a company. That's a filing of articles of the state. So let's not conclude I filed a company, I got a virtual address and EIN number and a transfer bank account with Payoneer. Nothing wrong with all of that, but that's not what we're talking about. We're talking about a complete formation. We do a lot of work with an operating presence between an address for a registered agent, your virtual mailing address. Then what's your operating presence? That's what banks want to see. That's what Stripe wants to see, Shopify payments, Amazon. If you're trying to prove you're really operating from here, they want you to really prove you're operating from here. Again, these all lead into what we're talking about. From the default point of view, then are we looking at either a U.S. corporation or a partnership? Is that a possibility too? Or does that still have some, I don't know, maybe some gray area that just the normal is a U.S. corporation, whether that's an LLC taxes the corporation or a corporation? Is that mostly what works in this area that doesn't seem to have issues?
That's a standard.
Okay, great. So let's stick with that standard. And we know by default, the U.S. corporate tax rate currently is 21% on net profits. You know, and we talk to people, it's assuming you're going to have net profits and you still plan. There's nothing wrong with having losses that carry forward, right? That could come into play. So some people are uncertain about these things. So we have the entity in place. A little bit on time frame from my end is the biggest issue with forming a U.S. company besides getting the strategy straight first. And obviously, if you're a bigger brand, you want to do a little planning. And when you work with us, we have two different ways. We can plan out everything, go talk to your tax advisor based upon the estimates of revenue. You think, are you going to do 2 million, 3 million, 5, 10, 20 million in the US? Are you going to be going to Shopify? Then we have a sales tax thing. What's going on here? You want to get your home country tax professional on the same page and the US tax people on the same page. And sometimes we can start with a strategy session, form the entity. Sometimes we do some planning. So we have a couple options there. Let's assume we get started with a tax strategy and we form the entity. The biggest thing that kind of slows it up a little bit is the IRS as far as the EIN number. Now, when you work with us, our order form that you fill out by yourself or with our team is very different because we ask you a lot of questions about what marketplaces, non-marketplaces, banking, address. So we line up all the dots so we don't have to amend something you filed somewhere else, especially TikTok Shop. We have to change some with the IRS. That's going to slow you up 6 to 8 weeks. So we don't want to do that. So when we go through, it takes a couple days to go through that. We double check it, make sure everything lines up. Then we form the entity. File the articles is typically a couple days, but then we got to fax the EIN to the IRS. And if you don't have a social, it could be 3 to 4 weeks to get that and to get the EIN letter. Then we set up a bank account and then we get to the point things are set up and then maybe it's capitalization. We would have introduced you to Eran at that time to say my entity's in play. I want to talk about transfer pricing. I want to get clarity in my strategy because the first question might be who's buying the inventory? Am I making a loan from my foreign company to the U.S. company? Am I going to capitalize it? Is a foreign company buying this? Who's buying that? So the bank account isn't set up yet, but you're planning these things. Does that sound about right?
Yeah, I just would drop I would just drop the loan. I think again, just to keep things simple, it's a contractual thing. So kind of like something in the contract can say that even like I'm buying, I will pay you. You invoice the U.S. entity, but payment will be in 30 days, in 60 days, in 90 days. Kind of like again, so we'll give kind of like the U.S. entity at least contractually, kind of like the buffer to sell the inventory, right, and incur some revenues before the payback. And again, that's actually aligns with the low risk entity that we want to say, says that all the risks, etc., are not in the US. Our US entity also has kind of like, like all those features of limited risk. For example, what happens if there's a dead inventory or slow inventory and I want money back? What happens if a client didn't pay and it's kind of like a bad debt? We can settle things in the contractually, and this is what part of the things that we do, that kind of like to make again, just like to align the actual facts, what's going on in the US. Almost an empty company that runs all those contracts and invoices, all the people, all the essence, most of it's outside of the US. So again, just like to align it with kind of like the low risk kind of like character that we want to do with the US end.
And that makes sense. So let's say we got that in place, and then we're going to, in our case, we're going to introduce somebody to you to say, hey, we want to get the transfer pricing in place, look at the three major different models, which ones might apply to the situation, which will kind of reverse engineer what goes into the documentation. Give us an overview just of, the documents that if we're going to refer somebody, what they might be called that you're going to be putting into place. What's the maybe deliverable time? And the famous question is this something I can do later, 6 months from now, 8 months from now? And I think we've already established that people know better that if you're a serious brand, there's some planning to go on from the beginning. So you want to get this in place. So tell us a little bit about, we hand it off to you. What does it look like on your end? What are some of the things you're putting in place? Then we'll give an idea on what fees might be so people have an idea versus, if they went to a big firm, what they might charge them.
Sure. So basically kind of like A to Z, I'm importing the goods. I want to make sure that it's a low price for tariffs. And I want to make sure that when we'll come to the end of the year, we will have the right profitable taxable income in the US entity. So basically, there are three documents that kind of like tell the strategy. One of them, it's what we call kind of like the invoice price for the tariff perspective. It's a wholesaler. What should be the price of a wholesaler? And we came up with a nice analysis that basically takes into account what the company already have. Let's say, hey, I have a smaller wholesaler in Hong Kong, and then maybe another wholesaler in the Philippines, and we provided them one 20% off, and the other one we provided 35% off. Whatever. So we take those data sets, and with these data sets, we can extrapolate and kind of like come up with a logical, using mathematical way, provide a logical estimation what should be the discount rate for our US entity based on those real cases, data sets that you provided us with the actual discounts that were already provided to someone else. So this is one thing. And in terms of the timeline, that's almost immediately, right? We have a shipment tomorrow. We need to come up with the right price. Okay, what should be the price? Here you go. So that's something that can, like something that like, because it's related to the transactional tax, to the tariff. So it's something that goes around almost immediately when we start to implement that. The other part, going back to the income tax, like, hey, what will happen? What should be done in the end of the year? So again, going back to this like same strategy of low risk distributors that we can add a little bit more about it. And again, that's not, I agree. It's not something that you have to do right now, just before, but something that you want to have kind of like, I know, in the first kind of like notion month after you operate it, right? You don't want to wait too much. You don't want to be in a situation that it's after the year end. It's a new fiscal year. You want to kind of like keep everything in the same fiscal year. And again, remember, income tax, it's looked on annual perspective, a fiscal year. I will add a few words about this. What's the transfer pricing? What's the model that we're talking about? I think it's important. But just to complete the picture, the third the third product, the third deliverable, it's what we call an intercompany agreement. Again, remember, we should We are looking at this US entity as a separate entity, as if it's a separate entity, as if it operates like a separate entity. Yeah, so we also need to have an intercompany agreement, a distribution agreement. But it's a smart distribution agreement in a manner that it already has all the features that support kind of like the model that we want to do, and also the model for the tariffs. Connect it lays out the risk that is, moving the title of risk before the goods enter the US. It has all the bad debt thing, the inventory risk, all those things that we mentioned before, and all those things. And I think this is really kind of like a nice way to look at it. Think of it as a boxing and winning in boxing in points. There's never knockout. There's never, oh, because you did that, that's it. No, it's always a set of points of things that kind of like draw a picture. So we want to win through points. So we have 1 point and more point and more points that kind of like tell the story. It's a low risk entity. We're using a discount rate because it's a wholesaler. It's a wholesaler because it has invoices, it has purchase orders. You have the whole frame that tells the same story. That will bring you in what we call to be in a better, stronger tax position in any other audit that you may have.
Makes sense. Very good. So that sounds good. So we refer someone to you, you evaluate the 3 different buckets that they may want to be in. Is it the wholesale situation? Are they in a situation with services? Is there any IP? And then that will kind of dictate what goes into the documents you put together, correct?
Correct.
And then the next step is, you'll get that information, put these documents together, then they'll start moving forward doing business. And then what comes into play at the end of the year? Now, in the U.S., what's interesting, if we are looking at a U.S. corporation, it can have what's called a fiscal year end, which means it can be any month of the year. It doesn't have to be December 31st. I know for Australians, they like it to match June 30th to match with their year end. It doesn't necessarily have to do that. I kind of like different months end for strategy, but that's a different subject. So let's assume it's December 31st. Whenever the year end is there any kind of review documents or support that needs to be done on your end that you have services for that people would reach out to you? How does that work?
Yeah. So so also I help with the execution. The good news is that it's something very repetitive. So once you kind of like know it and okay, we did it in the first queue, second queue, basically it's a simple execution, but this is something that I help. One of the typically I have like calls before the year end or before we finalize our financials around just to make sure that it's aligned with or we have a question. So 100% something that I do. It's part of the package to provide those assistance in kind of like readiness before year end, I would say. Sometimes at the call, we want to have a call with our local whatever accountant in Australia. All right, it's like those things happen sometimes, and something that like I said, it's part of the package. And as I said, the good news, it's something very repeatable because the same mechanism will go second queue, third queue, fourth queue, and so on and so on. This is one thing to consider. We spoke about like in those 3 documents that we said, kind of like look at it like a startup package. We just started an activity in the US or in foreign activity. And these are kind of like the 3 things. It's a strategy. You have the memo. We know what percentage to do. We know what discount to provide. We have an intercompany agreement. And kind of like, yeah, that's a startup thing. What happens kind of like if you do like fast forward, year end, fiscal year 25, fiscal year 26, fiscal 27, and on and on. Every fiscal year, because the IRS, income tax, they look on every fiscal year separately. What we're typically doing, we provide by the end of every fiscal year, what we call a transfer pricing documentation, which basically tells the story of what happens in the last fiscal year. So in 27, we prepare a transfer pricing report that will tell the story of what happened in 26. We sold a total of whatever, $1.3 million in the US. Our intercompany transaction was whatever. We purchased for $800,000. We had a profit in the US of 3% profit margin. And basically, that's what we need also for the compliance part. Check the box. Again, we're implementing the same strategy, but updating the figures for every fiscal year.
So with that, let me ask you, so is there an annual renewal fee to stay in compliance? Now, I'm assuming sometimes situations change. Maybe we want to stop the royalty for whatever reason. maybe the services we're going to increase, reduce, stop. Same thing with the inventory situation. Maybe some situations, is this a one and done? You pay for the first year package, all the support, but year 2, 3, if things are status quo, you continue on. How does that work as far as a brand, as far as what kind of support they would need from you on an ongoing basis, year 2, 3, 4?
So let's assume for a second that nothing has changed. We're buying the products according to the same strategy. Nothing has changed. Basically, the documentations that we need to do, again, it's once a year before they file the tax return. And again, it's always in the next year, right? So for 26, whatever that we're starting 26 in, the next time they will need to prepare the report will be somewhere in April or October 2027, right? So it's like an annual exercise. In this year, basically, it's like part of the preparation of closing the books and the tax returns. One of the things will also include the transfer pricing specific to 26. Same thing will be in 27. Again, nothing has changed. We just need an update, kind of like update benchmark, update with the update figures, what we had in 26 or 27. So that's like part of the documentation that needs to be prepared. And again, it's a list of features that what needs to be in this documentation according to the regulations. And basically that's it. It's a once a year exercise. Yet sometimes, business evolve, things change. We decided to do also X, Y, and Z. Now we are basically adding something else. Let's discuss relocation of people sometimes. Suddenly, hey, I have like cases that, let's say, one of the founders or the co-founders of the non-US entity decides to relocate to US because they want to, again, expand the business, going further, etc. That may change kind of like, hey, you know what, maybe the transactions are a bit different now. Maybe there's some management services. I don't know. Changes here need to be addressed and discussed. Maybe it's okay, but at least kind of like, and I think that this annual check, this is something that I do. I reach out, kind of like, hey, starting to prepare for the year end. My first question, what has changed? So this is what we had last year. Is there anything new in the business? Just to understand how to address it. If yes, let's address it. If not, that's fine. Let's just make sure that we have like an update document to support it.
And that would certainly make sense. What about somebody's in the situation where they're listening to this now? Could be a client of ours, and they've been operating for 3 or 4 years. They have a U.S. company, Australian company, maybe a EU company, or they're in Africa, something like that. We have clients in Africa, and they pretty much were just invoicing back and forth and kind of managing profitability expenses. And they never did any transfer pricing. Maybe this fall into the category of services. How do you do that just going forward? Is there anything you can do retroactively as documenting today on behalf of what you did in the past? So if you were audited, 6 months from now, you could, how does that work?
So the good news is like every fiscal, two things. Like I said, it's like for income tax, every fiscal year stands alone. And typically there's what we call a statute of limitation. IRS cannot go 7, 8 years back. They have like a limit typically of 3 years after the final tax year was filed. In most cases, in those scenarios that you explained, it's kind of like what happened in the past happened in the past. Starts now with this new strategy that will be applied. Imagine that even like an agreement. We don't have we never had an intercompany agreement. So we're setting up an intercompany agreement, and we can set it up with a certain effective date. Effective date will be 1/1/26. Will be maybe 3 months ago, but we have a starting point. And kind of like, again, it's going back, kind of like winning in points and managing exposure and risk. Yeah, there is risk for the 2 years ago. All right. Can you change it? I don't think it's worth it changing and reapplying tax. You'll ask any CPA, don't do that. Just like, it doesn't worth it. It's part of the risk that we manage. The 99% of the cases like start fresh from now and onwards. That will be kind of like my bottom line, better solution.
And that makes sense. It's not like you're going to amend a return and try to backdate some. That's just not going to work. So you got to move forward, start fresh. What about somebody that's in the middle of their fiscal year? Let's say, obviously now we're recording this happens to be November. Would you wait to put documents in place for January 1st? Would you put something in first for December 1st for the last month of the year? Does that make any sense?
I think it's case by case. The good news, we have more flexibility to do things within the fiscal year. So if there is some added value, it will reduce our significantly will reduce our exposure. It will save us money in taxes. Yes, we can do those things within the fiscal year. So we have still the window by the end of the year to make any of those adjustments that we want to do, again, to apply it on fiscal year. Few weeks from now, it may be too late. So we will have to start from that date and onward.
So that makes sense. It's not exactly like, oh, wait till December 31st, where there's certain rules with contributions, retirement plans, or April 15th, or whatever it is. It has to be reasonable. And so if you're
Fiscal
in this year,
yeah.
December 31st, you'd probably want to do it ASAP to kind of, is there something that could be adjusted for the current fiscal year? And then, of course, planning more for next year would be the big picture as far as how things are going moving forward.
Yeah.
So that makes sense. So, Eran, we covered a lot of strategies, the overview of what's required. Prices can change currently, what's being charged today and somebody 6 months from now. But can you give me an idea just of, let's talk from top down. Somebody, big multinational company, went to Deloitte, Ernst & Young. What are they going to pay for this kind of support? Maybe a mid-level CPA firm, and kind of a ballpark what your fees are, just so they can get an idea of what you've been able to do in this area and why it makes a lot of sense to protect yourself, manage risk, and also kind of get profits in the right buckets.
So kind of like I'm combining almost like three different experts, you can say. So you have like a transfer pricing expert that only for the actual transfer pricing memo, those fees in Big Four and kind of like middle CPAs can go between $8,000 to $15,000 to $20,000, right? Depends on the brand. Only on one part, only on the transfer pricing memo. You have another bucket of intercompany agreements that typically you'll go to a law firm to prepare those things. That's another kind of like a couple of, I don't know, $1,000 to $2,000 to $3,000 only to make this agreement. And lastly, kind of like another kind of like CBP kind of like, or analysis or economic analysis to come up with the price, to come up with the discount that we want to apply on our kind of like whatever, on the wholesale price of our US entity. Again, that's another hourly based. I mean, all those firms are based on hourly rate, new clients, those things. Again, I worked for 10 years in EY. I know how it works. And I think that if you look at this package that I just described, that can be easily between, I don't know, $15,000 to $20,000 easily. I mean, because you have three different TLRs, three different experts, trumps up together those fees. What I'm doing again, so this is going back even to when I incorporated the idea that was acquired by Avalara, and the idea was it's like what we call productization of service. There's no hourly rate; it's a product, and everything is transparent, and you know exactly what you get and how much it's going to cost. And we are using proprietary technology that we're implementing on IncoDocs, which basically can help make this work much more faster. Hence, we can have lower. The whole package of those three things for startup package, what we said before, it's a package of $3,000. $3,000, I would say $3,500 if it's something a bit more unique. $3,000 to $3,500. That's it. And again, all those three documents. The transfer pricing, what you need to do year after year after year, that's even lower. That's at $2,000, again, current prices, to make those updates. Again, nothing has changed. We're just updating the transfer pricing for fiscal 26, 27, and on. That's a $2,000 exercise. And one of the key things that I took into account with those fees, I'm specializing in SMBs. By far, the 99% of my clients are SMBs, not big companies. And in my idea, again, it's like it should be almost like a no-brainer that, of course, we are managing risk. Our clients managing risk. And if we can provide them a product that can help them reduce the risk, also with the tax planning and all those other features, which make sense in terms of budget, that's kind of like, that's my strategy.
And I agree, it's a no-brainer. It makes total sense for that low fee to get the peace of mind. You can sleep at night. You have strategy in the front end. You know where profits are going to be at. You've minimized risk. It totally makes sense. And I think the other element is, even with most of the different e-commerce CPAs we work with, they don't want to touch this subject with a 10-foot pole because it's a different subset of expertise. Am I saying that right?
Yeah, I guess so. Again, it's like every CPA firm.
Some might do it, but most are not going to put these things together for you.
No, yeah, 100%. 100%. And one of the key things also in IncoDocs, it's, going back to the vision, why incorporate IncoDocs, it's the same data that, and all this data basically it's already aligns with inside the companies, inside the clients, but from the same data. Like I said, you need an intercompany agreement, you need a transfer pricing strategy, you need a pricing for CBP, you need to make sure that you file your local accountant and your foreign accountant. You have basically, if you think about it, 4 or 5 different stakeholders, everybody using the same data. And basically our vision, what we're doing, we're using the same data and we provide an aligned, consistent documents that talk with each other in the same language. And I think in today's international tax environment, that's the single most important thing, because the amount of data that taxpayers, no matter what size, needs to disclose is a lot of data into all those forms that they need to disclose. Tax authorities change data all the time. They have the technology things to exchange data, and they have the regulatory platforms that enable them to share the data. If this is the case, everything is transparent today, everything is seen. The single most important conclusion thing for multinationals, it's consistency of data. Your agreement tells the same story of your transfer pricing, of your pricing with the CBP, of your invoices, of your income tax return in the end of the day. And again, it doesn't really matter what your tax planning and your tax position, as long as all those documents are aligned, you'll be in a stronger better tax position.
100% that makes sense. And I think you have to be smart enough to assume the governments, you know, maybe not as efficient as your business, they're there to generate revenue for their country, right? And they, like you, probably are using AI tools, scraping tools, new software to find new opportunities to go after people to find out which segment is not in compliance. And so this is not something, even from a U.S. point of view, if you've reduced your profitability here, that why subject yourself to a losing battle in an audit for something that was probably minor. Then they took a look at all these wires going out of your U.S. company to a foreign company, started asking more questions. It's just, you don't want it to unravel badly for you. So this is certainly something I think you said is a no-brainer. The amount of expertise and support you get in this very reasonable investment to protect yourself just totally makes sense when you're in a position that you are having 2 companies and there's some value. And this is one of those things now that you can have a comfort factor that if you were on the fence about having 2 companies, even though you'd like it, this might be the final piece that gives you that comfort factor that I'm doing it properly. I want to do it this way. And then that makes sense because back in my home country, I don't want all my eggs in one basket. I want to diversify and I want to be in that position to do it. Maybe I break off a piece and do an exit that we talked about. I just want to lower overall risk and manage my assets and business and opportunities for myself and my family. Those are my final thoughts on the big picture.
It's essential for any non-US brand to operate that sells into the US to do it with a US corporation. It's essential. It's not even the nice to have because of all the things that we've done. And the things that we have today with the technologies and service providers, it's not even a material significant expense. Again, and I think that the threshold in my head, from what I see, I would say $500,000 and above, it's already essential. It's nice to have if you have less. It's essential if you have $1,000,000 and more. That's already essential in today's environment.
Makes sense, 100%. So as a client of ours, as you're watching this, you may have been already introduced to Eran, working with him, and this will just give you more clarity as you're working with him. And if you haven't been introduced and you've watching this special bonus, send an email to our support team. We'll provide a proper introduction. We'll give a little bit of the foundation of your situation, and then Eran will pick up the ball, reach out to you, and then help you answer whatever final questions you might have, then get started moving forward to make sure you, your company, and your brand is protected properly. So that is what you want to do next. So we appreciate you watching today, and we look forward to working with you and for you working with Eran. Thanks, Eran, for being my special guest today. Appreciate all your effort and taking care of our clients, making sure they're protected.
Thank you for having me here, Scott.